Hey everyone, welcome back to another exciting video on Geek on Daily, the Geeky Trader. In today's video, I'm going to share a powerful trading trick that can help you secure fixed profits with a zero-loss strategy. This trick is called the Candlestick Range Trick, and it's something I personally used a long time ago with great success. Since many beginners struggle to find a reliable strategy, I decided to bring this method back and share it with all of you. It's simple, effective, and easy to understand, making it perfect for both new and experienced traders looking for consistency in their trades. So, if you're ready to learn a technique that can potentially improve your trading results, stay tuned and let's dive right in. All right, I'm spotting a potential opportunity here. So I'm going ahead and entering a sell trade at this level. The setup looks promising, and based on my strategy, this trade has a strong probability of playing out well. Now, while the trade is running, let me walk you through the strategy behind this entry. I'll break it down step by step so you can understand exactly why I took this trade and how you can apply the same logic in your own trading. If you take a close look at the chart, you'll notice a strong red candle forming. This isn't just any red candle. It's a powerful bearish candle that completely engulfs the previous green candle. This means that the sellers have taken full control, overpowering the buyers from the last move. What makes this significant is that the red candle closes in the opposite direction of the green one, signaling a potential shift in momentum. This kind of price action often indicates that the market could continue moving downward, making it a great opportunity for a short trade. All right, now it's time to focus on a key pattern that we need to identify, a setup where the close of one candle is equal to the open of the next candle. This is an important signal that can help us make confident trading decisions. If you look closely at the chart, you'll notice that the green candle's close is exactly the same as the red candle's open. This is the precise pattern we're looking for, and it plays a crucial role in our strategy. Now, based on this setup, I've identified my stop loss level. This level acts as my risk management point, ensuring that I exit the trade if the price moves against me. To make things clearer, I'll go ahead and draw a line right here to mark it. If the price moves above this level, I'll close the trade and reassess the market conditions. This is a simple yet powerful way to manage risk effectively while staying disciplined in your trades. Always remember, risk management is just as important as finding the right entry points. Now, let's take the next important step, setting our target level for this trade. Just like we set our stop loss to manage risk, we also need a clear profit target to ensure we lock in our gains. To determine this level, we follow the same pattern we used earlier, looking for a candle where the close of one matches the open of the next. If you look at the chart, you'll notice that the red candle's close is exactly equal to the green candle's open. This is the key pattern we're focusing on, and it helps us identify a strong level for our target profit. Since this is the level where price is likely to move within the defined win range, I'll go ahead and set my target profit here. This means that if the price reaches this level, the trade will automatically close, securing our profits without the need for manual intervention. This approach keeps our trading structured and disciplined, allowing us to take advantage of predictable price movements while minimizing emotional decision-making. Now that we have both our stop loss and target levels in place, we can let the trade play out and see how it unfolds. Instead of randomly fluctuating, the price respects certain boundaries, forming a structured movement within a defined range. Now, in this trade, I have identified these key levels. The price is expected to stay within this range, moving from one point to another, and that's exactly why we call it the Candlestick Range Trick. To manage risk effectively, I've set a stop level at this blue dotted line. If the price closes above this level, I will exit the trade immediately. This ensures that I take either a very small loss or, in some cases, even a zero loss, depending on how the market reacts. This approach keeps my risk under control and allows me to protect my capital. On the other hand, if the price moves in my favor and reaches the target profit level, I will secure a profit of $320. This is the level where I expect the price to complete its movement within the range, making it the ideal point to close the trade. All right, the price has reached our target, and just like that, we've successfully booked $320 profit easily and effortlessly. This trade is a great example of how professional traders approach the market. Instead of chasing random moves or relying on guesswork, they follow a structured plan. They identify key levels, set their entry, stop loss, and target, and then simply let the trade unfold within that range. By trading within a defined range, we minimize unnecessary risks and maximize profit potential. This method allows traders to stay disciplined and execute trades with confidence, rather than making emotional decisions. So that's how it's done. If you learn to spot these key levels and trade within them, you can make consistent profits just like the pros. All right, now, let's break down the candlestick range trick step by step so you can understand how to apply it in your own trading. Before entering a trade, the first thing we need to do is identify a strong entry position. To make this process easier and more visually clear, add a horizontal line to the chart. This will help us see key levels where price reactions happen. Now, take a look at this pattern right here. Notice how the red candle's close is exactly equal to the green candle's open. This is an important signal, and this specific formation is known as the engulfing pattern. The engulfing pattern is a strong indication of a trend reversal. It consists of two candles. The first candle is smaller, showing a temporary pause or hesitation in the market. The second candle has a much bigger body, completely engulfing the previous candle, signaling a potential shift in market direction. When this pattern appears at a key level, it suggests that the momentum is changing, making it an ideal point to enter a trade. A buy trade should be taken when a powerful green candle appears on the chart. This candle is significant because it absorbs the previous red candle and closes in the opposite direction. When a strong green candle completely engulfs a red candle, it signals a potential trend reversal. This means the sellers who were in control during the red candle are now overpowered by buyers, increasing the likelihood of an upward move. Once you've entered the trade, you need to have a clear profit target. A good place to set this is at a previous key level where an engulfing pattern was formed. These levels often act as strong areas of resistance or support, making them ideal points to secure profits. Take a look at this candle here. It's a powerful red candle, meaning sellers have taken control of the market. This red candle absorbs the previous green candle and closes in the opposite direction, signaling a potential downtrend. When you see this type of formation, it's a strong indication to take a sell trade, because this pattern suggests that buyers tried to push the price up, but sellers completely overpowered them, causing the market to shift downward. Now, let's analyze this next example. Notice how the candle's close is equal to its open. This is a key detail. Also, the red candle's body is bigger than the previous green candle's body. This confirms that sellers have complete dominance. This is a clear sell signal, suggesting the market is likely to continue moving downward. Now, let's flip the scenario. In this example, the candle's close is equal to its open again, but this time the green candle's body is bigger than the previous red candle's body. This means buyers have taken full control, overpowering the sellers. This is a strong buy signal, indicating the market to move upwards. If you look at how the market reacted after this buy signal, you'll notice a huge upward move, a great opportunity to capture profits. By learning how to read candlestick patterns properly and combining them with indicators like RSI, MACD, and Stochastic RSI, you can filter out false signals and make more confident and profitable trades. These indicators help confirm whether the trend is truly reversing or if the signal needs further validation. So, master these simple yet effective techniques, and you'll be well on your way to making smarter trading decisions with higher accuracy. That's it for this video. I hope you found it valuable and learned something new. Make sure to subscribe to the channel so you don't miss out on future videos. Also, don't forget to like this video. Drop a comment below and let me know if you found this strategy useful or if you have any questions. Thanks for watching, and I'll see you in the next video. Happy trading!